Marble Films is moving film production out of Georgia. Georgia has become a real hotbed for production, and a lot of this has to do with tax credits offered by states. And the people who make the Marvel films are now moving production out, and this is all about cost because many films are now and TV shows on streaming are being produced in Canada, primarily Vancouver, and also in Europe. Ireland's a good example because it is simply cheaper to operate. So this is a good chance to talk about variances. So a variance is a difference between actual costs and budgeted or planned costs. And you can think about variances like a cake recipe. Variances occur because you used more or less than you planned, like in a cake recipe, or the price you pay was more or less than you planned. So if you use more sugar or flour in a recipe, that's a variance from what the plan was. If you pay more for lemons or oranges in a recipe than you planned, that's also a variance. So in this case, let's talk about a labor variance. So let's assume that Marble's moving production to Europe. They were paying $30 an hour to a production assistant in Georgia. They can pay $25 an hour to the same person with the same type of job in Europe. They have a favorable variance because the new cost is lower than the cost they were paying before. Actual cost 25, budgeted plan cost 30. We're paying less. That is a favorable cost variance. An unfavorable cost variance means that your actual cost is higher than what you planned. You have variances that also exist with materials. You can use more or less materials than you planned. Your price you pay for materials can be more or less than you planned. So you can have a labor cost variance and a material variance. You can look at the variances combined. Finally, you can also have overhead variances for both fixed overhead and variable overhead. Same thing. Actual costs, fixed costs, actual costs, budgeted or planned costs. What's the difference? If you're spending more, it is unfavorable. If you're spending less, it is favorable. Finally, flipping it, you can have a revenue variance or a sales variance. If you sell more than planned, that's a positive variance. If you sell less than planned, that's an unfavorable variance.